Peter Lynch worked at Fidelity and ran the Magellan Fund from 1977-1990 and enjoyed an annualized return of 29.2%. Peter Lynch argues that the common man can outperform Wall Street experts by identifying companies they themselves use and enjoy. If you like the company, you might love the stock. Peter Lynch also goes on to state that most good companies have common characteristics that if an investor can identify, the investor can reap the rewards as the share price increases. Peter Lynch identifies 6 types of companies. They are: slow growers. Since you buy these for dividends, why else would you own them? You want to check to see if dividends have always been paid and whether they are routinely raised. When possible, find out what percentage of the earnings are being paid out as dividends. If it's a low percentage, then the company has a cushion in hard times. It can earn less money and still retain the dividend. If it's a high percent, then the dividend is riskier. Stalwarts. These are big companies that aren't likely to go out of business. The key issue is price and the P/E ratio. Will tell you whether you are paying too much. Check for possible diversifications that may reduce future earnings. Check the company's long-term growth rate and whether it has kept the same momentum in recent years. If you plan to hold the stock forever, see how the company has faced during previous recessions and market drops. Fast growers. Investigate whether the product that's supposed to enrich the company is a major part of the company's business. What the growth rate in earnings has been in recent years, 20 to 25% is great. That the company has duplicated its successes in more than one city/town, to prove that expansion will work. That the company has room to grow. Whether the stock is selling at a P/E ratio at or near the growth rate. Whether the expansion is speeding up, 3 new motels last year and 5 this, or slowing down. That few institutions own the stock and only a handful of analysts ever heard of it. With fast growers on the rise, this is a big plus. Cyclical. Keep a close watch on inventories and the supply-demand relationship. Watch for new entrants into the market, which is usually a dangerous development. Anticipate a shrinking P/E multiple over time as business recovers and investors look ahead to the end of the cycle, when peak earnings are achieved. If you know you're cyclical, you have an advantage in figuring out the cycles. It's easier to predict an upturn in a cyclical industry than it is to predict a downturn. Turnarounds. Most important, can the company survive a raid by its creditors? How much cash and debt does it have? What is the debt structure, and how long can it operate in the red while working out its problems without going bankrupt? If it's bankrupt already, what's left for the shareholders? How is the company supposed to be turning around? Has it rid itself of unprofitable divisions? This can make a big difference in earnings. Is business coming back? Are costs being cut? If so, what will the effect be? Asset plays. What's the value of the assets? Are there any hidden assets? How much debt is there to detract from these assets? Creditors are first in line. Is the company taking on new debt, making the assets less valuable? Is there a raider in the wings to help shareholders reap the beneficiaries of the assets? Key takeaway and quotes from the book. GARP, or growth at a reasonable price. GARP is the price/earnings growth ratio peg. The ratio divides a company's current P/E ratio by the earnings growth rate and is designed to measure the balance between growth and valuation. PEG optimal PEG ratio is 1 or less. An example of a GARP company would be Company XYZ, which is trading at $100 per share, and its earnings per share or EPS forecasted to grow at plus 20% for the year. ABC's P/E ratio is $100/$10 equals 10, and its PEG ratio is 10/20 equals 0.5. The PEG is less than 1 and makes Company XYZ a good GARP candidate. Understand the nature of the company you hold and the specific reason for holding the stock. By putting your stock in categories, you'll have a better idea of what to expect from them. Big companies have small moves, small companies have big moves. Consider the size of the company, if you expect it to profit from a specific product. Look for small companies that are already profitable and have proven that their concept can be replicated. Be suspicious of companies with growth rate of 50 to 100% a year. Avoid hot stocks in hot industries as they typically sell at a premium. Distrust diversification, which usually turn out to be diversifications. Long shots almost never pay off, they are for gamblers. It's better to miss the first move in a stock and wait to see if a company's plan are working out. People get incredibly valuable fundamental information from their jobs that may not reach the professionals for months or even years. If you work in medicine, look into pharmaceutical companies. If you work in energy, look into oil companies. Separate all stock tips from the tipper, even if the tipper is very smart, very rich, and his or her last tip went up. Some stock tips, ESP from an expert in the field, may turn out to be valuable. However, do your own due diligence. Invest in simple companies that appear dull, mundane, out of favor, and haven't caught the fancies of Wall Street. Moderately fast growers, 20 to 25%, in non-growth industries are ideal investments. Look for companies with niches. When purchasing depressed stocks in troubled companies, seek out the ones with the superior financial positions and avoid the ones with loads of bank debt. Companies that have no debt can't go bankrupt. It's incredibly hard to do, Lynch has joked. Managerial ability may be important, but it's quite difficult to assess. Base your purchases on the company's prospects, not on the CEO's resume or speaking ability. A lot of money can be made when a troubled company is turning around. Carefully consider the P/E ratio. If the stock is grossly overpriced, even if everything else goes right, you won't make any money. Find a storyline to follow as a way of monitoring a company's progress. Look for companies that consistently buy back their own shares. Study the dividend record of a company over the years and also how its earnings have fared in past recessions. Look for companies with little or no institutional ownership. If the company's a winner, institutions will follow. All else being equal, favor companies in which management has a significant personal investment over companies run by people who benefit only from their salaries. Insider buying is a positive sign, ESP, when several individuals are buying at once. Devote at least an hour a week on investment research. Adding up your dividends and figuring out your gains and losses doesn't count. Be patient. Watched stock never boils. Buying stocks on stated book value alone is dangerous and illusory. It's real value that counts. When in doubt, tune in later. Invest at least as much time and effort in choosing a new stock as you would in choosing a new refrigerator. Is the P/E ratio high or low in general as compared to the other companies in the same industry? Lower the percent of institutional ownership, the better. If insiders are buying and if company is buying back its own shares, both are positive. The earnings growth to date should be consistent, not sporadic, exception for asset play where earning Growth is not important. Company should have a strong balance sheet. Debt to equity ratio, how is it rated for financial strength?